Thank you for trying financetrainingcourse.com, an online collection of risk, Basel, treasury, and portfolio management resources created by risk and treasury professionals. Welcome back to our next session on stress testing. Before we move forward, I think it's time to quickly review the material that we've covered so far in this course. If you remember, we've done two sessions. In the first session, we walked through an introduction to the concept of stress testing. In the second session, we walked through an example of working with gold. I just wanted to collate both the sessions in a framework that we can work with as we move forward in our understanding of this subject. To begin with, the first element that we started off with when we looked at the example of gold was a pool of metrics. The element or a series of elements, a sequence of elements that we're trying to measure throughout our stress testing exercise. So in the example of gold, I think the concept or the component that we used, the first element that we used was price. So price of gold. And we looked at P&L. Earlier in the course, we've spoken about capital, we've spoken about capital adequacy, we've spoken about probability of failure, and we've looked at peer comparison. So that's one. Now, the second piece that we want to add immediately after pool of metrics is what is the relevant benchmark value. Once again, the benchmark value as far as gold was concerned was $2,000. We also looked at a benchmark value for volatility that ranged from 0.5% to 3.5%. We also looked at the movement that was possible in a 100-day period, and the movement that we worked with was about 5% and 35%. Now, the piece that we haven't spent a lot of time on, because we cover this topic in quite a lot of detail in our course on value at risk, so I would request you, or certainly recommend you, take a look at either the online material or the video courses on VAR. VAR or the approach using VAR plays an important role for two reasons. One, it gives you the ranges of value that you can use as part of your stress test. More importantly, you can very easily extend this framework to figure out the probability of a given event. And if you want to extend a little further, not just the probability of the event, but also I think the appropriate term for this is shortfall, the likelihood that you would fail, or the size of a move, or the forecasted predicted size of a move that would allow you to fail or require you to fail or make you fail. So this leads to a natural extension into the topic of testing stability of your business, of your capital base, and of the likelihood of your survival, both these elements. Then you can extend this analysis by identifying additional risk factors. You can go out and create a crisis plan for each of those factors and then test that crisis plan. As far as our course is concerned, our objective is to, so we've done this piece all the way till about here. Right? So we've done the metrics, we've done the benchmark values, we've done the probable and extreme scenarios. We still have to spend some time on stability, probability of survival, and risk factors. This piece, though, is covered in the value at risk course, and we may or may not cover this here. We might just add a component that walks you through the value of the, or just simply add an annexure that walks you through the value at risk component. And then finally, in terms of analysis, in terms of your work as an analyst, the real work that needs to be done is here, which is identification of risk factors, creating a crisis plan, and mapping that crisis plan. So, for example, let's go back to the same example that we've looked at, the one that we were working with earlier, that dealt with a fund manager who is or is dealing or working with gold. Now, if you see here, when I speak about the fact that your job as an analyst, or our job as an analyst, is to actually dig a little deeper beyond the mathematical modeling piece that we've covered so far, let's assume that rather than just working with spot gold, right? So spot gold, so the example here that we're working with deals with gold. Rather than working with spot gold, let's say that the fund manager says, look, I'm going to work with future contracts. I'm going to work with Asian options. I'm going to work with knock-ins, with knockouts, with lookbacks, and on bad days when I feel like it, might even do some traditional, conventional vanilla calls and puts. So now this is my universe of securities within which I invest, and rather than just working with one position of $1 million in gold, let's say that I have 1, 2, 3, 4, 5, 6, 7. I have 7 different products. So I have 7 positions of this $1 million distributed across 7 positions. The weightage of those positions is something that needs to be determined. The optimal weightage is something that the hedge fund manager wants you to recommend based on a stress test on the price of gold. So we've now quickly jumped from an academic approach where the idea was, what's the worst that can happen, to an approach where we're saying, no. We have a decision to make with respect to allocation of a portfolio across 7 different products. And what we really want to do is we want to make an optimal allocation, picking the right weightage for these 7 products, so that at least based on our historical analysis, the payoff is optimal. Okay? So we've now moved from an example where the focus was on looking at stress testing as a mechanism for identifying worst case losses, worst case shocks, worst case values, to a mechanism where we're actually using a stress test to fine tune and tweak our portfolio allocation across a range of products. Underlying exposure is still to gold, but the products that you choose will determine what your final payoff would be based on the weightage across the 7 options and choices you have in front of you. So this is an extension of the concept that we covered. Another variation of your analysis is, let's just add another dimension. Okay, another variation in this analysis could be that you'd say, look, my position is in gold, and let's look at a range of different factors. So the first factor is, what's the leverage that I carry? So is it 100% equity, or I've actually gone out and borrowed some more money? So this is number 1, right? Number 2, what is the level of stop loss? What's my stop loss limit on this position? So that's, factor or dimension number 2. Number 3 is, what's my tolerance for market volatility? Okay. Number 5 is, what's my holding period? If you remember, when we spoke about this earlier, we said, we've used a holding period of 100 days. How much movement is possible in a given 100 days? And last element is, what's my allocation across the 7 products we've just seen earlier, right? So now we're saying, look, gold goes from 1,200 to $3,000 US. If I use 100%, scenario number 1 is, I use 100% leverage, I use a stop loss limit of 5%, I use a volatility threshold of 3.5%, I use a 100-day holding period, and I do an even distribution across the 7 products. What's my payoff across these ranges? Right? So what's my payoff across these ranges? This is one scenario. Now I can very easily switch and say, I want to do at least, I want to borrow at least 50%. So, if I have $1 million and I want to have 50% leverage, then my overall exposure is going to be $2 million. So now this goes from 100 to 50. and my stop loss limit is tighter because I have more risk, so just 1%, and my volatility threshold, the fact that market may actually move against me, is also going to be a little tight because I have less risk tolerance given the fact that I have a higher position but lower percentage of capital at risk. So let's say I want to tighten this down to about 2%, and my holding day period is 60 days, and my product allocation is risk neutral. Okay, this becomes scenario number 2, and then you can play with variation. So each of these scenarios, you've got the underlying, which is gold, you've got a factor or a risk driver, which is leverage, you've got a control process, which is stop loss limit, you've got a market based indicator, which is volatility, you've got a portfolio decision, which is holding period, and you've got a portfolio decision, which is allocation across the 7 products. Each of these scenarios, all of these scenarios together, so each of these dimensions together across these ranges, there you go, represent a stress test. A combination of all of these is one stress test, and the input or the results, the input and the output that you produce from this framework basically takes you all the way back to what we'd seen earlier when we first introduced. There we go. There we go. So the work that we've just done is we said, okay, these are the risk factors, the 6 elements, the 6 dimensions that we've identified, these are the risk factors, and I have some indication of how my portfolio is going to behave when there is movement across these risk factors, and I actually have a crisis plan. So in the case of the fund manager who runs gold, the crisis plan is quite simple. The crisis plan is the minute you hit your 1% stop loss breach, you will liquidate. 1. The minute market volatility touches 2%, you will liquidate. The minute you touch 100 days, you will liquidate, right? So these are all elements. And what you really want to see is, if we go out and see the impact of each of these elements on our stress test, what's the final P&L? What's my final capital at the end of the specific exercise? So the work that we've done so far can be classified as something that is primarily related to what we call the risk of prices. Within the field of risk management, within the field of capital adequacy, prices are generally also, price risk is also looked at or evaluated as, or called or known as, or named as, or labeled as market risk. Right? So we've just covered the market risk piece. The same framework would work just as well for credit. And I have a very simple example here with respect to credit risk. Again, it's based on a framework that we've been working with for the last couple of years. So what you see in front of you is a very simple histogram that gives you a couple of key elements. So on this side, you've got exposure. So the amount of money that you've actually lent to somebody, going from $500 million to about $1 billion, right? And then on this side, you've got, I think the best term for this is credit quality. So how do you apply the concept of stress testing to credit? We've done market risk or price risk earlier. How do you extend this to credit risk? With respect to credit risk, what you're really trying to do here is saying, look, if I were to translate this into simple English, I'm saying my best customers, customers who pay on time, customers that I want to work with, customers that I want to lend money, ideally should all fall here in the 1, 2, 3, 4 range, right? My worst customers, customers who actually defaulted, customers who made me go out and provide capital to provide against the losses that I'm going to realize on their portfolio, are here in these 3 categories. Customers who are borderline, just before this are here, And then, this is something that is a function of my risk tolerance and my risk appetite. If times are good, if I have capital, if my outlook is strong, I would go out and lend money to these guys, to the 5s, the 6 and the 7s of the world. If not, then I would not. If times were tough, I would actually shrink part of my portfolio so that I'm only lending to the 1, 2, 3, 4s. And I would also stop lending to or actively, aggressively managing the 8s and 9s in my portfolio, right? So we're saying 1, 2, 3, 4 is great. 5, 6, 7 is could be. Is 8 and 9 is don't. And 10, 11 and 12 is trouble. Now the problem with 10, 11 and 12 is that you're saying these are customers who have already crossed the red line. These are customers who've already defaulted. These are customers against whom you have actually gone out and provided for the expected loss. So the term that we use, depending on which market you come from, is we say, we've already reserved for this, we've already allocated capital against these laws, or we've gone out and created provisions for the loss of this business or the loss due or on account of this business, right? Now, from a stress testing point of view, you have a huge range of variations and possibilities that could be applied when it comes to credit. The simplest is I've gone out and lent, let's say $10 billion. So I've gone out and lent 10, 1, 2, 3, 4. I've gone out and lent $10 billion here. So my stress test, very simple stress test, is okay, what happens if this 4, which represents, let's say, 30% of my portfolio, becomes a 5, a 6, or a 7? So there is a rating downgrade or a slide in the internal rating that you've used to evaluate or assess the credit worthiness of this customer. Or this 8 and 9, which right now has not defaulted, so and hence is not does not require me to provide for or create a reserve for this specific exposure. So this 8 and 9 becomes a 10 and 11, or God forbid, a 12. All right. So just in terms of distribution of my existing credit portfolio, there are two tests that we've just looked at. A downward revision and slide in credit rating for a performing portfolio that is current on its dues, a slide from a piece of the performing portfolio into the non-performing category, where again the exposure, where again what you're trying to assess is the additional or incremental amount of capital that you would need to set aside to protect for the losses that would be realized by this 8 and 9 becoming a 10, 11 or a 12. And then there are other variations possible. There are variations that deal with what is the amount of margin or collateral that's provided, or coverage provided by that collateral. So that's one element. There is another element that deals with, what is the forced sale value, the amount that you would get if you actually go out and sell that collateral to cover yourself. What's the forced sale value of that collateral, and how would that vary and change over a period of time, and so on and so forth. Okay. So quick review. We started off this session with introduction to a framework. Then we moved to an example of how this framework could actually be used in real instances, in real examples of using stress testing as a tool to tweak your portfolio. And then from there we jumped on to looking at additional risk factors that can allow us to build stress tests that are a lot more dynamic than just a static look at prices. And then we close that with extending the concept of stress testing that we've just discussed, that we just covered, to credit risk. The hope or the idea behind this structure was to give you a slightly more practical and a real life orientation to the topic of stress test. There's still a lot more to the subject that we expect to cover or conclude in the next few sessions. But for now, thank you very much for your time. I hope you've enjoyed yourself, and I hope to see you back soon. Thank you for trying financetrainingcourse.com. an online collection of risk, Basel, treasury, and portfolio management resources created by risk and treasury professionals.